Okay, let me start the webinar. Good day to one and all. This is Dr. Sivaraman of iKnowIndices.com. So I'll be giving the Tracking the Forex Market Together webinar, which is given in two parts, part one now and part two by close of the European session. So during this particular twin webinar, I give once a month. I explain to you the simple market tracking technique, identifying the type of moves which are made by the other players in the market, and try to find out what could be the next move in the sequential formation of the moves. And also we try to decide based on the type of move, how exactly we can make our entry and the exit decision making very simple. At the same time, we expect the unexpected. So always try to limit the risk and maximize the profit. With that philosophy, we try to use the hedging order to limit the risk and try to consistently earn money from the other market. So let us now review the market and then try to find out how exactly we can go about. Now it is 8 GMT. Straight. 8 GMT. So it is start of the European session. So during this European session start, we come across small swings to happen in the market, and that's part of the game. So they always try to make the swings during the start of the session. Why? In order to give that impression to the traders that euro could come down or euro could go up, or GBP could come down for the data, GBP could go up, and all sort of speculations can be derived based on the small quick moves which they try to make it during start of the session. So for that, we need to know the three important components, namely the derived forecast, what the forecast says, how the players are expected to make the moves in the market. Then afterwards, we keep the forecast in mind and fine-tune the forecast using the market reading technique. In the market reading technique, we note down the initial lows and the highs around 3:30 GMT and try to find out what exactly the market is trying to do using the live market quote page. Then we also use the trading strategy that when we take a decision of entering into the market, we keep 30 pips away from that, the hedging order to limit the risk. And once the position makes profit, we keep stop at entry and remove the hedge order, wherein we use the hedge instead of stop. And in the event if it is hedged, then we try to use it to limit the risk and keep stop at entry in the hedging. And thereby, when the market goes against us also, our usable margin is not eroded. And once the market moves in our favor, the hedge will be automatically closed when the stop is placed at entry. Then we try to continue to earn with the original position. So that is the trading strategy we use. Thereby, we find that the market is able to give us the profit even though it appears very volatile. So these are all the three components. So to start with, we will see the first component, namely the forecast. This is the forecast. I have given it on Monday, that is 2nd February, and during my Asian session live market analysis webinar. And in that, I was explaining that they will be making the swing and rise moves in the market, and more visible rise during the Wednesday. But yesterday itself, they gained substantially in the case of Euro and GBP, and thereby we will be able to see the visible upward bias. That is what I have given it in fxtrade.net in the blog post, that new month, new trend. The trend is expected to be upward. That is what consistently they are making it now, and which might give a surprise to that of the traders, and this is how the players make the moves in the market. So today is 4th of February. We come across swing and rise during that of the Japanese and the European session. European session starts by 8 GMT, and I'll give the part 1 of the webinar during this time. Now I am giving it, and part 2 I'll start from that of 14 GMT and try to find out how exactly their positions were closed with a profit. And later on, I'll take positions for the US session, and that also you can monitor later on how during the rise you are able to book profit. So this is the forecast. Now we will go to that of the market reading. In the market reading, we note down the initial lows and the highs around 3:30 GMT and try to compare it with that of the current market levels. And in the current market, if you refer it, Euro is showing a high of 1.1490 and the low was 1.1448 and 8 pips negative net change, and they are not breached the low or the high. In the case of GBP, 1.5139 is the low, 1.5175 was the high, and they breached the high and went up to 79 and come down, and they are holding around the 1.5170 with 0 pips net change. So that means what? From yesterday close level, they are just, okay, now they are gaining about 1 pip from that of yesterday's close level. And Euro, from that of yesterday's close level, they are just dipped about 9 pips or 10 pips. This is what you come across as a nominal dip in the market. Now, in the case of yen, so in the case of GBP, they breached the high and come below in order to gain the levels. And USD yen, 117.37 is the low. They are not breached. 118.01 is the high. They are not breached it. 23 pips positive net change is seen, 22 pips. And they are expected to make this swing. Sorry, only 1 pip positive net change is the 4th decimal. 1 or 2 pips positive net change is seen. And they are trying to gain the levels slowly, along with that of Euro and GBP as a contrarian move now. That's what they have been doing it during that of the mid-Japanese session. They will continue to gain the levels in the case of Euro, GBP and USD yen. As a result, yen crosses will go up. Then in the case of CHF, 92.28 is the low, 92.69 is the high. They just breached the low by 2 pips, and 92.26 they have formed as the low. And 18 pips negative net change is seen. So you find overall nominal swings are seen in the market. Now coming to that of commodity pairs, Canadian dollar, 1.2392, they just formed the low, initial low that they breached by about 4 pips and came down to 1.2388, and 1.2456 is the high. They are not breached it. So they are holding here in order to make a massive drop again in the case of USD CAD. And you know that they continuously gained about 1,000 pips. That is what I was explaining on Monday. And they are expected to make a continuous drop in this month. In the case of USD CAD, any level you buy, you will come across the loss. That sort of move. They will simply hold and pretend as if that is a support level and the market could go up. And at the maximum, they may gain about 50 pips, and later on, they will continue to drop. So this is the way they offload all their buy positions from the highest level. And quickly, they gained the level for the month end, and they wanted to offload all their positions to drop USD CAD in a big way. That is what they have done it in the case of USD CHF last month. And during the yearly trend reversal, they made a massive drop. And I was telling you that they are expected to reverse it again. And simply, if anybody sneezes also, they will try to make such moves. And SNB statement, they used it for that and simply made the drop and subsequently gained substantially from there. And what Euro CHF, that they are not pegged, that's what they said. They are taking it above that of 1.03. So that is how they try to cheat or try to deceive the traders and make the traders to believe all the stories, and subsequently they continue to create new stories, and that might be contrary to that of the earlier stories, but still they know very well the traders have got very short-sighted, and very poor memory, so they don't recollect what the statements were earlier made, how such new statements have become totally contrarian. And last month everybody was telling that US dollar is the safe haven, and in other places like Europe and other places, the economy is in doldrums, so automatically US dollar will continue to gain. That is what they have been giving that impression. But now, from that of the new month, they started gaining the levels in the case of Euro and GBP, forgetting about what they have been talking about Greece, what they have been talking about uncertainty in Eurozone, etc. And now you find that they are gaining the levels. So ultimately, the players create the sentiment and act against that of the traders. That we have to keep it in mind. So if you develop the bearish and the bullish sentiment alternatively, you find the trading becomes an extremely difficult task. If you calmly understand, okay, they are making a downward move, they are making an upward move. After an upward move, they will make a downward move. After a downward move, they will make an upward move. That's part of the game. If you understand that, then you will not develop the market fear. So for that, we need to use the market reading, find out how exactly they are trying to make the moves in the market, and they indicate beforehand what sort of moves they are going to do it. So as I showed you that in the case of CHF, they just cut the low and they cut the high. In the case of GBP, Euro, they are not breached the low or the high. And in the case of Australian dollar, and also in the case of CHF, they cut the low. And in the case of initial low, Australian dollar, 77.54 was the 77.54 was the initial low, and the 78.10 was the initial high. They just breached, went up to 78.49. And holding above that of 78.10. So it is a great technical buy opportunity because they are holding above that of the initial high for more than 30 minutes, and then they are sure to gain the levels. And yesterday they made the drop because of the interest rate cut in the case of USD, in the case of Australian dollar, and everybody thought that that is the end of Australian dollar. Australian dollar may not recover, but they just made one extended stop and on the downside. By US session, they regained almost close to 100 pips. And now you find that Australian dollar is around that of the level wherein they started yesterday. So you find that that sort of extended downward move, they simply make it as a knee-jerk reaction in order to accumulate buy positions. And afterwards, they slowly gain the level so that the traders think that, okay, this is the high we could sell. It is not able to breach that resistance, and Euro is looking very heavy. It is not able to go above that of this resistance. So this sort of weightage, we try to give our presumptions. And once we give the weightage to the presumptions, we become bearish and start taking the sell position. Later on, find the players continue to gain the level and force us to do the short covering. So this is what we need to understand. So what they had done, they just breached the initial high in the case of GBP and holding it during the session start time, not breached the low. And in the case of CHF, they breached the low. In the case of Canadian dollar, they breached the low. And in the case of Australian dollar, they breached the high and stay above. And you know that the commodity pairs lead the rally and lag behind. So it has already breached the high and staying above. So that means they are going to do the US dollar weakening move during the day. Okay. Now we got that clue from the other market. So we have to do buy and sell trade. So this is what the session timing. So 8 GMT, the European session starts up to 14 GMT. So live market quote page we use and try to find out what sort of moves they are doing. They are only making the swings here now. So I'll explain to you the type of moves afterwards and also how to use the hedging. So we'll first take the positions. So in the case of Euro, it is not closer to low, but it is in the middle level. So 1.1467. So we'll try to. So we don't come across the bid and the ask here. So this is the open price, and this is the high and the low. So we have only one level here, the last price. So 1.1467. We'll take a buy. So after seeing yesterday's gain of about 150 pips, and it might give that impression to that of the traders, there will be some correction move on the downside before making further rise. But the players are here to give that impression that it could make a drop, but they make only a sideways move and start gaining the levels in GBP after the GBP data by 9:30 GMT, and then they will follow the sentiment and gain the levels in the case of euro also. So exit, we are not keeping it. At the moment, we can keep 45 pips above that of the entry level or 75 pips above that of the entry level if the going is good. Since yesterday they had done about 150 pips gain in the case of euro. So we will wait for further gain in the case of euro. So keep a mental limit order of 75 pips above this. And to limit the risk, we'll keep the sell stop 30 pips below that of the market. In the case of GBP, 1.5167. It is a buy position, and again we'll keep a sell stop. $5,137. Then I told you Australian dollar is breached the high and staying above, so we will try to take a buy 1.7815. Sorry, 0.78. With 30 pips hedging order, sell stop. Now I was telling you that they're also gaining the levels in the case of USD yen, made the contrarian move. So we'll try to take a buy because they initially showed all the three currencies negative net change during start of the Japanese session, and followed by that they slowly gained the levels. So they intend to make a brief downward stop and then gain the levels in the case of euro and GBP. Along with that, they will gain the levels in the case of USD yen also. So we will try to take a buy position in the case of USD yen. 117.50 is a contrarian trade. We aim for about 50-60 pips profit. $117.20. Then I'll try to take more position, but you should not over trade. Keep that in mind. So let me stop with this because sometimes what happens, which gives the wrong signal to the other traders that they can take positions in all currencies, because your equity is going to determine how far you are going to take the positions, and you should not take more positions just like that. And if the market goes against briefly, it might give a drastic impact on your margin. So that you have to keep it in mind. Okay. I think it was struck, so I just took slightly higher level positions. Anyhow, they are all for a demonstration purpose only. Okay, these are all the entries we had decided. Then we'll come to that of the type of moves. So in the live market code page, if you watch, I've given you the session timings in GMT. So this GMT time you can watch, and then subsequently you can find the levels at which the currencies are making swings in the market. And that also you can find out. And the first 30 minutes, and if you look into that of the session timings, from 8 to 9:30 GMT will be the early European session. 12:30 to 14 will be the late European session, and 9:30 to 12:30 will be the mid-European session. The early and the late sessions, they handle the majors, and the mid-session, they handle the crosses. So they make up and down moves during the early session in the majors, and then subsequently during that of the European session, they make the contrarian move. Sometimes gain the level in the case of Euro, drop JPP, or gain the level in the case of JPP and drop Euro. That sort of moves, they do it in order to handle the crosses. And again, they come to that of the majors during late session. So if you're trading in majors, you have to choose the early or the late sessions. If you're trading the crosses, then choose the mid session. And always keep in mind they handle only two pairs at a given time. So identify those two pairs, and those two pairs will show a spread of more than 40 pips between the initial low and the high. Between the low and the high, they will show more than 40 pips. And if they show more than 40 pips spread between the low and the high, that indicate that they are handling those currencies. And then try to take positions in those currencies. You'll find the going will be very good, and also quickly you'll be able to book profit. The spread is only about 10 to 15 pips. If you try to commit a position, you may have to hold it for a long time, and you may not either see yes good profit, or it might be in loss for about 2 hours. So that sort of trades you should avoid. So for that, you have to find the spread between the high and the low, and then try to take the positions. Then identify the type of moves they are doing it. What they do is a stop and. A stop and is the move which they do it during start and the end of the session, during the early and the late sessions. First 30 minutes, they try to make a brief downward stop and then go up, or a brief upward stop and come down. So during that time, if you watch and try to take the position during a small dip, you'll be able to quickly see the profit making. So a stop and is the one which happens in less than 30 minutes. So they come down and reverse the market in less than 30 minutes before 8:30 GMT. And a false move is the one they come up to that of the low, without breaching the low, they go up again. And that is referred as the false move. So a stop and a false move happen in less than 30 minutes. So watch for the timing using the live market code page, and also note down in GMT, because the Greenwich Meridian time, the GMT time, is the universal time. So if you use it, we'll be able to easily find out how in 24 hours market, during different sessions, they handle the market differently, and then try to create the sentiments alternatively, and that will help us to take an appropriate decision, that they will not make a continuous bearish move or a continuous bullish move in the market. Even though the market, they may call it as bearish, but still buy and sell trade will give a greater profit. And sometimes they will say the market is very bullish, but the sell and buy trade might be giving considerable profit. So it doesn't mean that we have to do the contra trade all the time, but we have to find out what sort of moves they are doing it and then try to take positions. And if you fail to identify the type of moves, then you might get struck. During a stop and you might think that it is a breakout trade. So you try to take a buy position above that of the initial high, and later on they just drop the market. So you have to find out whether it is a contra trade potency or not. Then a move which happens for 2 hours, more than 30 minutes, up to 2 hours is an extended move, which is again a quick move. They quickly make a drop or quickly make a rise in order to just induce the traders to commit wrongly. And during the session start time, when they quickly dip, immediately the traders think that, okay, it is a falling market and the data is also negative, so we'll go and sell. That is what the traders will commit sell position, and later on see that the market is not dropping further. And also, we happen to be the last seller at the lowest level. This is what happens many times for the emotional traders. They quickly try to enter into that of the running bus and see that the bus has already reached the destination. And then afterwards, they hesitate removing that or close the position. They think that, okay, anyhow, the data is negative. There will be a small profit at least. Like yesterday when they had dropped Australian dollar, people would have taken a sell position after the drop of 120, 130 pips. And later on, when it is not making further downward move, then quickly reversed it during the European session, then such traders, they tend to average their sell positions. So they try to take further sell and see that, okay, they'll be able to close it with a nominal profit once they make a brief drop. And they continue to make further rise and see that such short sellers who sell after the drop get trapped. So ultimately keep in mind that in the market, you find the players create the market sentiments. But once the sentiment becomes visible, if you try to commit position, it happens to be a wrong trade. At that time, trend is not your friend. And keep in mind, during that of the month end and the month beginning time, trend is not your friend. Only during that of the second and the third week of the month, the trend is your friend and you will be able to follow the trend and take positions. So don't blindly follow such things, because invariably what happens, then whatever we try to perceive and take position, when the position is not making profit, we discontinue with following such events. But you have to understand each and every statements in a market have got their own limitations. So that limitations, if you don't understand, and if you don't understand statistics, but you only understand the terminologies of the statistics, then it is extremely difficult, because we'll jump from one statistics to another statistics without understanding why you are doing it. And ultimately you find that you lose your money. So avoid that. Instead, you try to stick on to any one method and try to find out what is a flaw in it, try to perfect it, and also give importance to that of the common sense. See, your common sense is vital, and that has to be understood, and that gives the insight for you, and don't simply ignore it. And in the falling market, you might find that, okay, it is a buy opportunity, but it is a buy opportunity provided the low has not been breached for more than 30 minutes. That way, if you try to relate the levels with the time, then you will find the trading becomes sensible for you. Then the intentional move is the one which happens for more than 2 hours and up to that of the 2 sessions and the start of the 3rd session. And that will be a slow move, whereas the extended move is a quick move. So quickly they will make a drop just to give that impression to the traders it is going to fall, or quickly rise to give that impression that it is going to quickly make an upward move, but they simply make a reversal later on. So always you have to understand that in the financial market, if the money has to make money, they have to be cunning. That is the only means by which they will be able to earn money. So the cunning move is a cheating move. So they try to make a move in such a way that it is going to dip. but later on they rise the market. So how they dip it? They do the circular trades and dip the market. And later on you find that it gains up. Circular trades in the sense they sell it to themselves and they buy it again from their cells. So in the process, if there are stops, such stops will also be taken out by the other players. And when they do the circular trade among themselves, they don't lose, even though in the dropping market when they sell. And later on, any traders sell, they absorb all the sells and gain the levels, like now, how they gain the levels in the case of Euro and GBP. And later on, when the traders buy, they just make a small dip of 10 to 15 pips or 25 pips and book profit with the buys and again accumulate new buys and gain the levels in the market. So you have to understand that the players have got huge positions. And so such huge positions, in a matter of few hours, they will not be able to liquidate. So what they do is they take longer time and try to make such moves in the market. And then only they will be able to either accumulate more positions or just liquidate their positions. So if they offload their billions and billions of positions in all, you'll find there will be a nightmare happening in the market. So they will not allow it that way. What they do is every day they distribute, gain the level, distribute, gain the level, distribute. That's what they have done, the higher level consolidation with a frequent upward stop. And when Euro was around 1.39, 1.40 area, GBP around 1.71. At that time, when I was telling that the market is going to drop, but everybody was looking for further rise. So that is how they create the sentiments in the market. Now again, around that of the lower level, they are creating the sentiments to that of the traders that the market is going to fall in a big way. But ultimately, they have started accumulating the buy positions and they are going to show a new trend in the market, and which will be an upward move. In the event, so we had taken a decision to enter into the market, a buy position, and later on keep 30 pips hedge order to limit the risk, and 45 or 75 pips limit order to exit, and also keep 30 pips hedge order. And once the position makes profit, we'll keep stop at entry and remove the hedge order so that the hedge order will act as a stop instead of stop. If you keep the stop order, then it will close the position. Whereas if you keep the hedge order, another position will be taken, provided the platform has got a hedging facility. And later on, once you close the hedge order, the original position will remain as such. The hedge order, you can close it with stop at entry without any loss, or with 1 or 2 pips loss, you can close it manually also. When you find that they are not dropping further, you can book a small profit also and keep another hedge order to limit the risk, and then trail the hedge order upward when they are trying to gain the levels. That way, you can easily understand what they are trying to do it in the market by looking into the live market quote page, because the live market quote page is the one which shows the levels without any delay. Whereas if you use the charts and you find the bars are updated depending upon the time frame you select. So instead, you can simply follow the live market quote page, which will be equivalent to that of a tick chart. Tick chart will be very unwieldy when you try to spread it. Instead, if you use a live market quote page, you will be able to easily understand what they are trying to do it in the market. Now, if the position is hedged, and if the market continues to make a drop, then you can keep stop at entry in the hedge and book profit in the hedging on the downside. Like yesterday, Australian dollar, they made a huge drop, and you can simply watch the last 30 minutes, they don't cut the new low. Then close the hedge position with a profit, keep 30 pips below another hedge order. Then once they start gaining the level, you can trail the hedge order on the upside. And once they go above your buy position, keep stop at entry and remove the hedge order and book profit on the buy side as well. Because market can only do 2 types of basic moves, one an upward move or a downward move. When you have the hedging, you find you have one position either during the drop or during the rise that will be making profit, and understand the type of moves they are doing it, and book profit on either way trading. Now, coming to that of the positions at that time, no, the live market quote page was struck. So anyhow, I just taken the positions because we have the hedging facility. So we should not hesitate about it. Still, we'll be able to see profit. So Euro is making a loss and still it is not hedged. The low has not been reached. And in the case of GBP, the low has not been breached. And in the case of yen, the low has not been breached. We have the buy position Australian dollar. They have not come to 77.85. And in case if it is hedged and if the hedging is not making profit for 30 minutes, then close the hedging with 1 or 2 pips loss, or we stop at entry and keep another 30 pips below, another hedge order, or 15 pips below. And once they start gaining the level, you trail the hedging order upward. And that is a task. You have to do it. Only then you'll be able to really handle your position without any influence of the market moves. Otherwise, invariably what happens, the market, when it makes sudden move, people become afraid. And some people simply close the platform. And some people close their eyes. So just because you have closed the eye, the market is not going to stop making moves. No, it will continue to make the moves. So it is a question of only weak-mindedness. And if a person is of a weak-minded condition, then it is extremely difficult for him to make money from that other market. So any profession for that matter, you need to have a courage and the self-confidence. The same is necessary in the case of trading also. In the trading, people may talk about human psychology. People may say that don't become bearish, don't become bullish and things like that. But you have to find your strength and weaknesses by yourself. And others can find it, but to a lesser degree. But you yourself will be able to find out whether you are weak-minded, you are not able to withstand such pressures in the market. Then either you decide not to trade if you are really weak-minded, or if you find that by education you will be able to really equip yourself, then first of all, physically tune yourself by taking adequate water so that the endocrine, which is secreted, endocrine hormones secreted in the blood gets diluted. The adrenaline gets diluted, and afterwards you find that slowly you are able to accept such quick moves happening in the market. And so it should not create any sort of frightful condition for you. That is one physical condition. Then secondly, you have to develop the mental strength. How to develop the mental strength? And some people say that you can do meditation and develop the mental strength. But my simple suggestion will be expect the unexpected. Okay, I have taken a position. There is a possibility the market can come down. So presume it. The market can go up or come down, but I have used my studies and I have used my strategies and tried to take in that position. Okay, if it goes against, okay, I got the hedging to limit the risk. So I will not incur a loss for more than 30 pips. Even if they make a very quick move for the data release or a small dip, I will not incur a loss for more than 30 pips. If you have got a predetermined information available for you, you will not become frightened. So, which is the triggering factor for all your emotions being triggered? Basically, the surprise. So, once you become surprised of the market moves, then you go in for the crisis management. So, avoid becoming surprised. So, how you can avoid becoming surprised? Think of both the possibilities. Then, once you think of both the possibilities, then you become a professional. A professional is the one who envisage both the possibilities and plan accordingly. As a result, if the project go through, he will be able to use the strategy and just establish himself. If the project goes against, he will give an alternative and he will try to see that he is not affected badly. So ultimately, a professional is the one who has got solution for either way moves. So if you want to become a professional trader, be prepared for either way moves of the market, and then you will be able to see that consistently the earning happens for you. Nothing more than that. So let me take the questions which are asked here. Okay. Then Shan has got a question. If we use euro and euro Hong Kong dollar as hedging, there is one buy position, another sell position. Is it okay or need to check the margin requirement? So obviously the margin for euro Hong Kong dollar and euro USD will be different. And also, you know that Hong Kong dollar is a pegged one. So you may not come across much of a move there, whereas euro can make about 500 pips move against you. So always the same currency, using the same currency for hedging will be ideal so that the margin will not go away. Then Black has got a question, Black Cat. How can a trader get more confidence? Okay. Getting the confidence is not merely the success rate of the trade. Getting the confidence will be much more improved if you are able to see profit in your trades. So my entry may be wrong, but if my trading strategy is successful, I'll be making profit on either way moves of the market. Then I get more confidence. Hope you're able to understand. So I have given the forecast and I have also given the market reading, and also I have taken based on the market reading the positions. Now euro is hedged 1.1437. We'll watch for about 2-3 minutes. If it is not going below, we'll try to close in 10 minutes time. Minimum 10 minutes, maximum 30 minutes. And since I've been watching it for more than 18 years, so I know how they'll handle it. So I can close it in 10 minutes time, provided if you are able to watch the market like that, only the live market code page without the charts, then you will also develop the skill set. So it is not the forecast which is going to give the confidence. Because if you ask anybody giving the forecast, they will say that it may work for about 70%, 80%, 90%. If somebody says that the forecast is 99.9%, it is reliable. Still 0.01% error can happen. And if you choose to take positions during such error times, 2-3 times, you will be demoralized. So that is statistics. So keep in mind that it is not the forecast which is going to give the mental confidence, and it is a question of the trading strategy. So that is why I give importance to that of the trading strategy, and that is vital for anybody to make money. And in that process, what you have to see is that, okay, I am using the hedging. In the event if the position is making loss, my position will be hedged. And I will look into that of the hedged position, whether it is making profit or loss for 10 minutes to 30 minutes. And if it is continuously making loss, I'll cut it with 2-3 pips loss and keep another hedge order. Then later on, I'll find that the market goes up and I'm able to keep stop at entry and remove the hedge order. And then the position continues to make the profit. So ultimately, they can only make a downward move and then upward move. Always the early session, if they make a downward move, keep it in mind. Late session, they will make an upward move, provided they are within that of the high and the low. But if they cut the low and stay below there for more than 30 minutes, that means they will make an intentional move for 2 sessions on the start of the 3rd session on the downside. So that is why identifying the type of moves using the initial lows and the high is vital. and especially after a losing streak. Yes, when you continue to lose, that's what I told you. No, you might have a forecasting system which might be about 90% confidence level might be there, but if you happen to take positions during that of the 10% error time, and if you lose in 2-3 trades, you lose the confidence in the system, in the calculations. Actually, no, it is a question of the impulsiveness which has made you to take positions during such a risky time. 90% of the time, your forecast might come true, and those 90% might be during the trending time. During the trend reversal time, you'll come across the variations from that of the expected line of forecast. So avoid taking positions during that time and take positions only during the trending time, following the charts, following the statistical calculations which are prevalently used, you will be able to book profit. But the same will not work during trend reversal time. So unfortunately, what happens when you use the charts, we only use it as a 30-minute chart, 4 hours chart, and 1 day chart, etc. But we fail to understand the session timings, how the players are making the moves. And also we are not able to predict when the drop is going to happen, when the rise is going to happen. We only say that, okay, if it breaches the resistance or breaches the support, but the time is not associated with it. My forecast is the one which is associated with it of the time and the levels. That is why I want you people to make use of it. And I'm not expecting any reward out of that or no subscription and things like that. I want you people to get rid of the market fear and make some sensible trades. Then FX said, is it possible to get a copy of your PowerPoint? The PowerPoint is being recorded and which will be available in FX Trade under the archives of the webinars. So you will find in another 1 or 2 hours, the recording will be available there. Then FX Trade. Can I explain hedging Euro USD that you have placed? Yes. Now, the hedging, I placed it. And as I explained that if you wait for about 10 minutes, already about 20 minutes gone. So I'll be incurring a loss of about 10 pips. So I'll So I narrated here that the hedging is closed with a loss of 3 pips and then subsequently kept another hedge order 30 pips below. And once they start gaining the levels, I'll move the hedge on the upward. So that way the hedging can be handled. And in case the hedging is making profit for 10 to 30 minutes, then keep stop at entry in the hedging and let them come down anywhere. And once they form the new low or make a net change of 150 pips on the downside in the net change, beyond that, they will not be able to make a drop or you just sell. On during trend reversal time, they can go above that of 150 pips on the downside or on the upside, then wait for the new low to be formed. And the new low should not be cut for 30 minutes. And they should not go above that of the new low for more than 30 minutes or above that of the new high for more than 30 minutes. Then you close the hedge and keep another hedging order 30 pips below and let them gain the levels and you move the hedging order along with that, maintaining 30 pips. And once you find that your buy position makes profit, keep stop at entry and remove the hedge order. Thereby, the purpose of hedge order is over to limit the risk. Now, if they hit your stop at entry, you don't incur any loss. Then subsequently, you find they start gaining the level. See how they are doing it. now. So ultimately, you have to understand they make the swing. So I've been giving the webinars. Otherwise, if I watch carefully from 10 to 30, 10 to 10:30, 8 to 8:30 GMT, when they make a small dip and come closer to the other low, I'll just pick up the buy. And if the buy low is not been breached for more than 30 minutes, and if they just make a small dip and go above, then immediately if you take a buy, you will find instant profit in the positions. So for that, the initial lows and the highs are vital. If you simply calculate the support and the resistance for 30 minutes, 5 minutes, and 2 hours, 4 hours, 1 hour, and 1 day, and things like that, you really get confused whether it will be following the Fibonacci retracement or whether it will be following the support and the resistance, or it will be following the MACD or whatever it is. So invariably that leads to that of further uncertainties. Basically, we use all the statistics in order to narrow down the uncertainties and try to take an appropriate trading decision. In the process, if you try to waste your time in analysis, you simply miss entering into the market. That's what happens most of the time, especially when you lose money in 1 or 2 trades, then you hesitate really entering into the market, even though you think that it is going to work. So for that, ultimately, to gain the mental confidence, you need to use the trading strategy. Give importance to the trading strategy. Don't think that it is fool's idea using the hedging. Or somebody says that if you use the hedging, you do not know the direction of the market. And I can bet here, nobody in the world can predict the direction of the market from second to second. Because even the players, they make the moves in the market and they can also expect the unexpected calamities. And when such unexpected calamities happen, they also do distress trades. So it is not that they have a total control on the market. So keep in mind that focusing on the prediction and trying to perfect it is fine. But in the process, you try to fine tune. By the time you missed your trading opportunity and you become a good analyst, and that may not be able to give you the expected income. Then Monol, I just took a position in USD CAD, just went know if I process in the process of thinking. Is good the high and the low has been set. The current quick move that happened be a false move since the breach of the high returned below high. Okay, in the case of USD CAD, it was around 1.2415. I think at that time we have taken the position, keep 30 pips hedge order, and the case hedging is filled because they have to make small swings. They are handling the commodities now, the commodity crosses. That's why they made a quick rise. Keep the hedge order. If there is hedge, watch. And if the hedging is not making profit for 30 minutes, close it and keep another hedge order. Then later on, they will make a drop and try to keep stop at entry in your sell position. And then they will try to come down. Okay. So you try to do all these trades in a demo trading platform, understand how to use the hedging. And just because the webinar timing is being from 8 to 8:45, so I have to forcibly take the positions when I am talking to you. But otherwise, you have to watch following the rule what I have given it from 8 to 8:30 GMT. You have to watch and see what they are trying to do. So if it is closer to low, you can only buy. If it is closer to high, not breach the high, you can take a sell. That you have to keep it in mind as a basic trading strategy. Then you will not commit mistakes. Okay. So let us review the positions, what I have taken it. And so nominal losses are seen in the case of Euro, GBP, and USD and Australian dollar positions. And I'll show you by 14 GMT what happened to these positions. And then you'll be able to understand how, with the narrations here, you'll be able to understand how a position can be entered. And it need not be exact perfect level. It can be around that also fine, as long as you use the hedging to limit the risk. And then subsequently, exit is important. The exit will be early session I entered, so late European session I will exit out of the positions with profit. I will show you how that is being done during part 2 of the webinar. So you please come back by 14 GMT and track the market from 8:45 to 14 GMT and come back by 14 GMT. I will show you what happened to those positions. Then afterwards, I'll also commit new positions for the new session, and you can see how exactly the forecast, the market reading, and the trading strategy are helpful in consistently making profit from the market. So I take this opportunity to thank FX Trade for the facilities provided, and I'll come back by 14 GMT and continue with it of the forecast. Please come back.